After going through this module, you will be able to learn about the pension funds and pension plans and management of pension plans, pension system in India, and reasons for growing importance of pension funds in India. You will also learn about pension reforms in India, about PFRDA. Learn about current pension schemes in India, including NPS, NPS Lite, and APY. Introduction. In India, most of the people are self-employed or work in unorganized sector. These people don't have any kind of financial security in their old age. Access to pension is available to people who work in organized sector. Population dynamics is changing. Old age income security is major social economic concern for the government. Hence, pension reforms are a major issue for policymakers. Pension funds act as a financial intermediary, and at the same time, it provides income security to the elderly people of the society. Pension funds, in short PF. A pension plan is an accumulation of funds over working years of an individual, which is paid back to him in his non-working years after his retirement. Pension funds are now growing at a very fast pace and acting as a powerful financial intermediary. Pension fund is an intermediary who receives contributions, accumulates them, and makes payment to the subscriber in the manner as specified by the authority. Pension fund has to register itself with the authority and obtain certificate of registration from the authority, that is PFRDA. Functions of pension fund. Functions of pension fund are decided by the terms of its certificate of registration. Pension fund has to follow all the regulations issued by authority from time to time. Pension plans. Pension plan is a method to provide regular monthly income to the participating individual when he retires. Pension plans are sponsored by employers or labor unions. Employer can be central, state government, or private employers. Pension plans can be of following types: defined benefit pension plan, in short DBPP. Under defined benefit pension plan, an employer or plan sponsor promises a specified monthly benefit on retirement. This monthly benefit is predetermined with the help of formula. This formula is based on employee's past earnings, total years served, and on his age. In India, government as an employer and public sector enterprises mostly provide this type of pension plan. Defined contribution pension plan, DCPP. As the name suggests, under defined contribution pension plan, the contribution made by the both employer and employee is predefined. Both employer and employee make contributions on regular basis. The benefit to be received after retirement totally depends upon the earnings of the funds. Defined contribution pension plan are also known as money purchase pension plan. Pay as you go pension plan. In this type of pension plan, beneficiary decides his contribution. This contribution can be deducted monthly from his or her salary or can be contributed in lump sum. The employees can choose from various investment options. Management of pension funds. Most of the sponsors appoint trustee to manage their pension fund, and very few sponsors manage themselves their pension fund. Trust department of any insurance company or commercial bank or mutual fund is generally appointed as trustee. Trustee has a responsibility to invest contributions provided by the sponsors and to pay benefit to the retired person on time. Some large sponsors can appoint more than one trustee to manage their pension fund. In case of DBPP, sponsors use to provide investment guidelines regarding portfolio consumption, selection of securities, and target returns. If pension funds are managed by trustees, then it has few advantages. Firstly, the trustee has greater expertise in investing the funds. Secondly, transaction cost is very low. Thirdly, appointing a trustee increases the credibility of the pension fund. Generally, pension funds have fixed and predetermined flow of funds in and out every month. The amount contributed by the sponsor, that is employer, and participant, that is employee, are predetermined. Hence, liquidity is not a big issue for the pension fund, but their main consideration is associated risk and return on the funds invested. Pension funds mostly invest in high-yielding long-term assets. Generally, DBPP invest in fixed income assets and DCPP prefer to invest in high-yielding corporate equities. Both DBPP and DCPP invest considerable amount of funds in mutual funds or insurance companies also. In few developed countries, pension funds have emerged as an active and big institutional player in securities market. Many countries have allowed private companies to actively participate in pension fund sector. Ultimately, this has resulted in the development of financial markets. Reasons for growing importance of pension funds in India. The reasons behind the fast growth of pension funds in India are: 1. Nuclear families. Nowadays, nuclear families are more popular. Earlier, in joint family system, younger members of the family took care of the elderly members in the family. But in nuclear family system, it is difficult for young members to take care of elderly members as they live apart from them. So this gives rise to pension funds. 2. Longevity. Another reason for growing pension funds is longevity of people. People live long life after their retirement. If a person is self-employed, then he can work beyond the age of retirement. But if person is salaried, then he gets retirement at certain age. And after his retirement, his non-earnings years start. People are retiring younger and living longer life. They spend longer years in their retirement years. There must be some kind of financial arrangement to finance the old age expenses. Pension funds are the only option in this situation. 3. Reduced dependency on others. With an arrangement like pension funds, an individual becomes self-dependent. This reduces his dependency on others for his financial needs. 4. Increase in elderly population. India is known as a young nation with a large number of young population. But after a few decades, this whole young population will become old. At that time, they all will need pension to finance their expenses. So pension funds are a good option for young citizens to save for retirement period. Pension system in India. Till 1999, in India there were very small coverage of pension. Only organized sector employees were covered under pension system. Employees Provident Fund, in short EPS, Employees Pension Scheme EPS, and Public Provident Fund PPF were the only few schemes available to the employees. People having government as their employer were only beneficiary of the pension, and this pension was generally defined benefit pension plan. People working in private sector were covered by Employee Provident Fund, and this was mandatory for them. Indian pension system has seen many policy changes during the year 2000 to 2009. First, OIC project was launched and then interim PFRDA was set up. National Pension Scheme was launched. Current pension schemes operating in India can be broadly classified as 1. Civil Service Pension Scheme, 2. Employee Provident Fund EPF, 3. Employee Pension Scheme EPS, 4. National Pension Scheme NPS, 5. Voluntary Pension Scheme. There are two types of scheme under this: A. Personal/group pension plan, and B. Public Provident Fund. Pension reforms in India. By increasing retirement age from 60 to 62 years, pension payments are deferred. Defined benefit pension system replaced with defined contribution pension system. Setting up of Pension Fund Regulatory and Development Authority, in short PFRDA. Introduction of NPS and extending the scheme to state governments, autonomous body and unorganized sector. Introduction of NPS Lite for economically weaker section of society. 6. Maximum entry age is increased to 60 years under the NPS, as this will enable more and more people to join the scheme. Pension Fund Regulatory and Development Authority, PFRDA. In 1999, Government of India launched a nationwide project named OASIS, Old Age Social and Income Security. After the recommendation of OASIS report, Government of India replaced the defined benefit pension system with new defined contribution pension system. This new defined contribution pension system was for all the new recruits in central and state government service, except to armed forces. In order to develop, promote and regulate pension sector in India, on 23rd August 2003, Government of India established Interim Pension Fund Regulatory and Development Authority, PFRDA, through a resolution. On 22nd December 2003, Government notified the contributory pension system. Now it was named as National Pension Scheme. NPS came in effect from 1st January 2004 for all the new recruits to central and state government service except armed forces. Subsequently, from 1st May 2009, NPS was extended to all citizens of the country, including unorganized sector and self-employed professionals, but on a voluntary basis. On 19 September 2013, the Pension Fund Regulatory and Development Authority Act was passed. PFRDA regulates NPS and confirms the orderly growth and development of pension market. Preamble. Basic functions of PFRDA are described by the Preamble of the Pension Fund Regulatory and Development Authority Act 2013. Preamble is as follows: to promote old age income security by establishing, developing and regulating pension funds, to protect the interest of subscribers to schemes of pension funds and for matters connected therewith or incidental thereto. Composition of the PFRDA. The composition of authority is as follows: a chairperson and not more than 5 members, of whom at least 3 shall be whole-time members, to be appointed by central government. Current pension schemes in India. In India, following pension schemes are available. 1. Employees Pension Scheme, EPS. Employees Pension Scheme was made mandatory in 1995. This pension scheme is operated by Employees Provident Fund Organization. This pension scheme is applicable to all the employees of all those factories and establishments where Employees Provident Funds and Miscellaneous Provision Act 1952 applies. The benefits under EPS are: 1. Superannuation pension, 2. Retirement pension, 3 disability pension, 4 survivor pension, 5 widow pension, 6 orphan pension. Employer has to transfer 8.33% of employee salary to employees' pension fund. Central government also contributes 1.16% of employee salary to this fund. Minimum pension of Rs 500 per month is provided under the scheme. Amount of pension is based on average salary of past 12 months from the date of exit and total years of employment. A person has to give the name of his spouse and all children in prescribed form. If a person is not having family, then he can nominate any other person. Funds received under the scheme are generally invested in government securities and government deposits. 2. Bank Employees Pension Scheme. Public sector bank employees are covered under this pension scheme. The scheme was started by the Bank Employees Pension Regulations 1995. Bank has to constitute pension fund under a trust which is irrevocable trust. Bank contributes to the fund equal to the 10% of salary of the employee and accumulated contributions of the bank to the provident fund and interest accrued thereon till the date of such transfer. An employee with a minimum of 10 years of service on the date of retirement will be eligible for pension. Employee can nominate any family member as beneficiary after his death. 3. Insurance Employee Pension Scheme. This pension is covered under General Insurance Employees Pension Scheme 1995. All the employees of General Insurance are covered under this scheme. Corporation or company shall contribute 10% per month of salary of the employee in the pension fund. An employee with a minimum of 10 years of service on the date of retirement will be eligible for pension. Employee covered under this pension can nominate any family member as beneficiary after his death. 4. Privately Administered Superannuation Fund. Employers can create privately managed superannuation fund. All the accumulated funds must be transferred to irrevocable trust fund, and when the employee retires, then suitable annuity plan has to be taken up from LIC. Otherwise, company can purchase any superannuation plan with LIC and pay contributions for the employee. 5. LIC pension plans. In the recent past, LIC has launched few pension plans. These plans are LIC New Jeevan Nidhi, Jeevan Akshay 6, New Jeevan Suraksha 1 and Varisht Pension Bima Yojana, etc. National Pension Scheme, in short NPS. On 1st May 2009, Government of India launched NPS for all citizens of India and corporate sector from December 2011. National Pension Scheme NPS is regulated and administered by PFRDA. NPS is a retirement savings scheme with defined contributions. NPS is voluntary. It is designed to create habit of saving for their retirement among individuals. NPS provides a sustainable solution to the problem of providing pension to every citizen of India. NPS is for all the new recruits to central and state government service except armed forces. The person who joins NPS scheme is known as subscriber. In order to join NPS, every subscriber has to open an account with Central Record Keeping Agency, CRA. This account will have a unique permanent retirement account number, in short PRAN, as an identity. Under NPS scheme, a pension fund is created through pooling the individual savings. These funds are regulated by PFRDA and they invest funds as per approved investment guidelines. Usually, these funds managers invest funds in government bonds, corporate debentures mutual funds, bill and shares. These funds grow and accumulate as per the returns gained on the investment made. Two types of accounts are available to subscribers under NPS, that is Tier 1 and Tier 2. Tier 1 account. Tier 1 account is a non-withdrawable account in which subscribers contribute their savings. It may also include employer contribution. Tier 2 account. This is a voluntary saving account. Subscriber can withdraw their saving anytime, whenever they wish. One must have active Tier 1 account for opening of Tier 2 account. Institutional framework of NPS. PFRDA has appointed National Security Depository Limited, NSDL, as the Central Record Keeping and Accounting Agency, CRA. PFRDA has appointed a custodian, 3 pension fund managers, and a trustee bank for NPS. All the contributions received under NPS are transferred to NSDL. Subscribers' contributions are invested as per investment guidelines. Exit from NPS. On 11th May 2015, PFRDA has issued exits and withdrawals under NPS Regulations 2015. In accordance with these regulations, subscriber can exit from NPS. CRA has been assigned the duty of receiving instructions related to all types of withdrawals, processing, and settlement of all claims under NPS scheme. CRA has created a NPS claim processing cell, NPS CPC, for processing all the claims application under NPS. NPS Lite. NPS Lite is an alternative model of NPS to provide financial security to economically weak people coming from low-income strata and having lower educational background. On 1st April 2010, Government of India launched NPS Lite. NPS Lite is having low cost structure, government co-sponsored schemes, GCS, self-help groups, aggregators, and government welfare and affinity groups are covered under NPS Lite scheme. NPS Lite can be joined through aggregator and subscriber can be in the age group of 18 to 60 years. Atal Pension Yojana, APY. In the budget year 2015-16, Government of India announced and started a universal social security scheme named as Atal Pension Yojana for the poor and underprivileged people. This pension scheme was launched in June 2015. The scheme is open to all bank account holders. Minimum age of joining APY is 18 years and maximum age is 40 years. Subscriber can exit from the scheme at the age of 60 years and pension will also start at the age of 60 years. Central government will contribute 50% of the total contributions made by the subscriber or rupees 1,000 per annum, whichever is lower. Depending on the contribution made by the subscriber at the age of 60 years, subscriber will get guaranteed minimum pension of rupees 1,000, 2,000, 3,000 or 4,000 or 5,000 per month. In order to open APY account, individual must have saving bank account. One should approach the bank branch and fill up the APY registration form, provide mobile number and Aadhaar number. One has to keep required balance in the saving bank account. One has to provide nomination details in APY account. Spouse will be the default nominee in case subscriber is married, and if the subscriber is unmarried, they can nominate any other person as nominee. After attaining the age of 60 years, subscriber has to submit the request to the concerned bank for drawing the guaranteed minimum monthly pension. One cannot exit from the APY before 60 years. Generally, exit is not permitted. PFRDA can permit exit only in exceptional cases, that is, death of the beneficiary or in case of terminal disease, etc. Summary. A pension plan is an accumulation of funds over working years of an individual which is paid back to him after his retirement. Pension fund is an intermediary who receives contributions, accumulates them, and makes payment to the subscriber in the manner as specified by the authority. Pension plans are sponsored by employers. There are three types of pension plans: defined benefit pension plan, defined contribution pension plan, and pay as you go pension plan. Most of the sponsors appoint trustee to manage their pension fund. Trustee has the responsibility to invest contributions provided by the sponsors and to pay benefit to the retired person on time. Nuclear families, longevity, reduced dependency on others, and increase in the elderly population are the reason behind the fast growth of pension funds in India. Till 1999, in India, there was a very small coverage of pension. Only organized sector employees were covered under pension system. On 23rd August 2003, Government of India established Interim Pension Fund Regulatory and Development Authority (PFRDA) through a resolution. PFRDA regulates NPS and confirms the orderly growth and development of pension market. India at present have following pension scheme: Employees Pension Scheme (EPS), Bank Employees Pension Scheme, Insurance Employee Pension Scheme, Privately Administered Superannuation Fund, and LIC Pension Plan. On 1st May 2009, Government of India launched NPS for all citizens of India and corporate sector from December 2011. NPS is voluntary and regulated by PFRDA. NPS Lite is an alternative model of NPS to provide financial security to economically weak people coming from low income strata and having lower educational background. Government of India announced and started a universal social security scheme named as Atal Pension Yojana for the poor and underprivileged people. The scheme is open to all bank account holders.